Hi, friends. This is Brant Spessart with Steward Strategies, and I just want to say thank you for tuning in for a few minutes as I share our 2025 mid-year economic update. So, we at Steward Strategies believe that our best clients, make informed decisions with knowledge. Knowledge is power. We believe stewardship involves making wise decisions. We want to be good stewards with the advice we give because we know our clients want to be good stewards with the financial resources they have. So this is why we periodically share webinars, newsletters, but also give the one-on-one advice with meetings with our team as well. When you think about your financial plan, we have to remember though that there's more to our financial plan than just our investment statement. Financial planning has a bunch of different areas, and the decisions or the actions we take in any one area may affect other parts of our financial plan as well. So we always have to have a holistic approach. And the areas of financial planning that most of us have are retirement planning, investment planning, protection planning, tax planning, and estate planning, but also cerebral strategies. We truly believe that, look, we're blessed to be a blessing. How can we use these resources in our financial plans also boost, enhance, encourage generosity as well? So today I'm just going to give you a quick equity market update, talk about some ideas and strategies to keep in mind, but also just really tax law update coming soon. So over the past couple of years, we saw great growth in the market in 2023 and 2024, but in 2025 we have seen a lot of volatility. We came off 2022 where we had extreme volatility and declines that year to great growth in 23 and 24. And then all of a sudden in 2025, we've had significant volatility. Now, if you fell asleep at the beginning of the year and you woke up at the end of May, you would have actually seen a little bit of growth and you would have been fine with that. But the problem is most of us experience volatility and have to deal with the headlines on a day-by-day basis. I mean, if you just look at the first few months of this year, we had a great January and then kind of a quiet February, but then we had extreme drops in volatility in March. The end of first quarter was very difficult, but we had a very mild April. And then in May, we had one of the best Mays in the past couple decades. So it was a great month. And actually, June was strong as well. And, through the end of Q2, we actually had good growth so far this year. But we have to think about what causes some of the concern. And really, the concern for a lot of us is actually driven more because of the headlines that we see. We all know the saying, buy low, sell high. It makes sense. We understand that. But we're all human. It's personal finance. And we see these headlines where we're bombarded, with solicitations to click here, watch this, read this, listen to this. If you think about some of the headlines we saw back in April during this extreme volatility, on April 4th, it was a Friday, we had the headlines that said, the Dow's dropping 2,200 points, the S&P plunges 6%. Human nature for a lot of folks is, gosh, that's kind of scary right there. And sometimes that's when people want to get out. And sometimes if they feel that way, they may say, well, look, I want to get back in when things feel better. Well, when's it feel better? After it's already recovered, right? And what happened within just a couple days? April 9th, Dow jumps 3,000 points. NASDAQ soars 12%. Between Friday and Wednesday, if somebody got out and they just waited literally a couple business days before looking at the headlines again, they would have seen, gosh, markets kind of rebounded a little bit. And that can be disastrous right there because we know the saying again, buy low, sell high. But sometimes when things go down a lot is when people actually want to get out. They don't want to really get back in until it feels better. Well, what happens there is we may react and sell low and buy high. And it's hard to recover from that. And that's why you always hear us talk about how investments need to be for the long term. If you just look at equities over the past 10, 20, 30, 40 years, there has been tremendous growth. But along the way, there's been tremendous volatility. Think about the 21st century, the 2000s. What have we seen over the past 25 years? In 2000, we saw an all-time high in first quarter, and then we saw and felt the tech bubble burst. Then we had 9/11. Then we had the '07 to '09 Great Recession. We had government bailouts. We saw headlines about Brexit. We saw headlines about debt ceiling crisis, sovereign debt crisis, global pandemic. We had Republicans and Democrats. We had low interest rates and high interest rates and high inflation, low inflation. We had a lot of headlines that would definitely cause a lot of concerns. It would definitely cause a lot of people to say some of the most dangerous words in investing, which is, but this time's different. But if anybody got in and hung on over that 10, 20, 30, 40-year period, wealth was created. Now, this is all using the S&P as just a general index. There were times where people may have made bad, individual investments. But if you look at where you were born and where the market was and where the market is today, wealth has been created. Now, some of the headlines that we're seeing on a regular basis have to do with interest rates. The Fed's meeting 8 times this year. They've met 4 times so far, and they have not adjusted interest rates yet. We will find out more in a couple weeks, towards the end of July when the Fed meets again. The Fed uses interest rates to try to control the economy. Back in 2022, when we had sky high inflation, the Fed raised interest rates at the greatest pace in 4 decades to try to slow down the economy. So we'll see what's going to happen. But interest rates are used a lot of times to help fight inflation. The Fed, when they meet to look at interest rates, the two of the things that they're actually measuring are what's inflation look like and what does unemployment numbers look like. Well, right now, inflation actually looks and feels pretty good. We're at lower inflation than where we were a couple of years ago. Inflation was around 9% back in 2022, and right now it's in the mid 2s. Target inflation is about 2%, so that's what the Fed's paying attention to. Now, here's the thing. Lower inflation does not necessarily mean that prices have come down. It just means prices aren't going up at the same clip that they once were. Tariffs have caused a lot of volatility this year. Tariffs have commanded a lot of the headlines. And there is ongoing global debate right now when it comes to trade policies and tariffs. Our largest trading partner is China. And we're going back and forth with China. As of the time of this recording, tariffs have been assessed and it's caused volatility in the market. Here's what we have to keep in mind with tariffs, though. Will tariffs increase prices to where the consumer feels inflation, and will that cause a recession? Time will tell, but a lot of this is going to be more short term. Just like with some of the headlines we're seeing regarding geopolitical conflict and the concerns that come from that. Ukraine and Russia, there's still activity going on there. Iran, Israel, what's happening with Gaza. There's a lot of conflict globally, and there always has been. Our job here at Steward Strategies is to try to help be that calm during the storm. It's also a very expensive time, for borrowers. Interest rates were extremely low a couple of years ago. And I was kind of shocked when I saw some of these numbers out there. For those of you with children or grandchildren that are young adults, warn them about the cost of borrowing. Credit cards right now can have interest rates up to 28%. Mortgages are, historically, interest rates right now for borrowing when it comes to mortgages, vehicles, it's not really that bad. But they are higher than where they were a few years ago. And also rent and home prices are up as well. Now, higher interest rates are a good sign for safe or conservative investments. Bond yields right now, 30-year treasuries were around 5%. That's pretty strong right there. CDs and money markets are still paying really decent interest rates. But we have to know that if the Fed adjusts interest rates, though, that can also cause some volatility as far as those markets are concerned. When the Fed raised interest rates at a significant clip back in 2022, it not only caused volatility for the stock market, but it also caused volatility for the bond market as well. So what do we do? What should we be thinking about? If we see all these headlines, where do we go from here? So control what you can control. I know a lot of us, we're human. It's personal finance. We worry sometimes. The most dominant human emotions are fear and greed. But our role here at Steward Wealth Strategies is to try to give you advice that's going to be in your best interest and help you with your financial plans. So sometimes when there's crisis or concern, there can be opportunity. So the opportunities during a market downturn, one, add new money to your portfolio. Buy low. If you have money that's for the long term, buying great quality investments at lower prices can be a bargain sometimes. Rebalance an existing portfolio. We do this internally for a lot of our clients, and that's very strategic to do during market volatility. Or possibly converting some traditional IRA to Roth while values are at a temporary low. But then also some other strategic tax planning, whether it's gifting or loss or gain harvesting, can also make sense during times of volatility as well. But we have to remember that volatility is part of the investment experience. The price for growth is volatility. If we don't want volatility, then we're probably going to have our money sitting in something that's not making very much long term. We have to focus on long term, but we also have to stay diversified. Focusing on staying in the market during times of volatility is critical. It's time in the market, not timing the market, that helps us succeed. Look for advantages during downturns, but also try to limit as much exposure to some of the headlines that we see as well. Sometimes what we feed ourselves can cause more anxiety and stress and harm than the volatility itself. So do you have some of the basics? Do you have financial liquidity? Think about some of the basics that should be part of every financial plan. A lot of you have found us because of our Ramsey affiliation over the years. Think about the baby steps. Do I have a fully funded emergency fund? How am I doing with debt? Do I have any consumer debt? Am I 100% debt free? Have I thought about my upcoming obligations? So having a game plan as far as our spending, like a budget, living within our means, having a fully funded emergency fund, not being strapped with debt. If we can check off those boxes right there, we can get through most economic downturns that we may come into. So just know, interest rates have been held steady, but we'll find out more over the next couple of weeks if the Fed's going to make any changes. The market correction that we experienced this past spring, it was extreme, but it was short-lived. But volatility remains. Every headline regarding trade and tariffs, as well as tax laws that have come into effect, are going to cause some sort of volatility and maybe even some concern. But you've got to stay the course and focus on the long term. And remember, we're here for you. Reach out to your Steward Wealth Strategies team, because the best financial plan in writing doesn't do anything if we don't stick to it. Use us as a resource so that you can be prepared, but also to help you focus on your long-term commitment. Tax law changes. So as of the time of this recording, the One Big Beautiful Bill was passed. We will be providing updates and new information with you or for you as we have information that we can share. I think the tax bill was over 900 pages, so there's a lot to digest for everybody. But as our software updates and we have more information that we can share, what we feel will be meaningful and relevant information for our clients, we will be doing that here very soon. Our role as your advisor is, help you avoid knee-jerk reactions. Be a wise steward. Make good financial decisions. Try to make decisions that aren't panicked and have a non-emotional objective. Do you want your financial advisor to panic and react with every headline? No. Our job here is to be the calm during the storm. We're here to help you make decisions that are in your and your family's best interest. Reach out to your financial advisor, your wealth manager, your client service associate, your wealth associate here at Steward Wealth Strategies. We have a team to take care of you. We are here for you. We do care tremendously for our clients, and we want to be a resource for you. Follow us on social media. If you're not already, check us out on Facebook, Instagram, LinkedIn. Subscribe to our YouTube channel. This webinar will be uploaded there shortly. Recently we were honored by our team members with a survey that we conducted that, ranked us as one of the best workplaces for financial planning firms in the Triangle area. We're very excited about that. But you, our client, also blessed us earlier this year, and we were rated one with the Voter Choice Award through WRAL for financial planning firms in the Triangle area. Thank you. We want to continue to serve folks like you. A lot of you found us because of our Dave Ramsey affiliation, but a lot of our clients also come from you, our best clients. So please be an SWS ambassador. Keep us in mind if you have a friend or family member that seems concerned and you think, hey, look, they probably need to talk to somebody that's going to give them advice that's in their best interest. A lot of times people need a second opinion. A lot of times people are listening to sometimes, unfortunately, sales pitches on the radio that are not necessarily, may or may not necessarily be financial advice that they need to follow. So if they want to speak with a SWS team member, please reach out to us, make a connection. We'd be honored to serve them just like we're honored to serve you. I just want to say thank you for taking a few minutes, investing some time, watching this webinar. We're grateful for you and we're grateful for your trust. And we hope that everybody enjoys the rest of their summer. God bless you and thank you.